Hello and welcome to our webcast. I'm Danielle Johns with Moss Adams, and I'm going to get us started for today's session, Spring Not-for-Profit Tax Update. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to turn it over to our moderator for today, Tracy Paglia, partner here at Moss Adams. Tracy, the floor is yours.
Helps if I unmute. Thanks so much for coming today. It's wonderful to have so many people on the webcast for our spring tax update. We thought today, rather than having set slides where we're going through set presentations, we would do a panel presentation. So each of our fantastic panelists has chosen a couple topics that they'd like to talk about, but we're also going to have audience participation, and you get to choose which ones we talk about. We'd also like to take your questions down in the Q&A box. We do have a lot of people on this webcast, so we might not get to your questions, but we are allowing time both during the presentation and after the fact to answer questions. But if we don't happen to get to them, on your slide, on your screen, you can see our contact information. Feel free to follow up with any of us after the presentation. So with me today, we have Lauren Haverlock, our brand new partner in our LA office. So happy to have Lauren with us today. Her fun fact for today is she is a marathon runner, and when she is running her 65 miles a week, she likes to listen to podcasts. So if you have any new or noteworthy podcasts that you'd like to forward on to Lauren, she would love to get them because she is listening to them all the time. Also with us today is Patty Mayer, our tax director from San Diego. I've been working with Patty for years, I think pretty much my whole career, and I am so pleased to have Patty with us today. She is so knowledgeable about everything going on with tax exempts. And her fun fact is she loves Disney. Before COVID, she had the opportunity to visit Tokyo Disneyland, which would be an amazing trip, and I'm going to have to see those pictures the next time Patty and I get together. Finally, we have Liang. She is with our San Francisco office, one of our newest hires, and we're so thrilled to have her today. Even though she doesn't have a green thumb, during the pandemic, she decided to take a stab at gardening and has collected over 100 plants in her house. So if you have any suggestions for keeping them alive, questions about keeping them alive, or new plants she should try next time, please let Yuen know. So with that, we are going to go to our topics. There we go. In no particular order, time permitting, we're going to be going over various topics that you would expect us to talk about, including what's happening at the IRS, issues you should be thinking about for your remote employees, what in the world is going on with the ACE Act that we've been hearing about for a year that doesn't seem to be moving, and what's new with the 990 and the 990T. So with that, we would like audience participation. Not only do you need to answer the questions for CPE, but we would like to know which topics you'd like to hear about. So the 4 that we're going to start with, if you could please vote. I think, do I need to open the poll? No. There we go. Poll should be open. If my tech people can confirm, my poll is open. Vote for the U.S. Treasury Green Book, General Explanations of the Administrative Fiscal Year 2023 Revenue Proposals that affect nonprofit organizations, the ACE Act and what's happening with that, what provisions are in there, IRS exam activity, and remote employee issues. So I am hoping to get, oh, there we go. 269 of 432 have submitted. Terrific. So we are going to leave that poll open for a few minutes because we would like your feedback on what you'd like to hear about, and that's the first topic we'll talk about. Give you a couple more minutes here just so you can get credit. And I'm seeing that I cannot see the poll from someone in the chat. So if tech can help respond to that, that would be great. Seem to be having problems with the poll. Danielle, do I need to be doing something different to launch? Oh, everyone is saying they can't see the poll.
I can forward it to the result. If you cannot see the poll, please enlarge the slide area. Then you should be able to see the submit button. If you cannot see the poll, there are some icons that are at the bottom.
We do have 392 responses, so it seems to be working for most people. And the poll is still open. I haven't closed it yet. I'm seeing the poll is viewable in the slides. So if you have slides minimized, you'll want to open that window. All right.
It's a surprise to us as well. We can't see the results yet, so it'll be interesting to see what's winning out.
Yep, I have not advanced the slide yet to close it because I wanted to give people an opportunity to vote if there was an issue. Okay, so we've got 407 of 440. So in the interest of time, we're going to go ahead and close the poll and advance the results. So the number 1 topic chosen was remote employee issues with 42% of the vote. So that is where we shall start, is remote employee issues. So Lauren, one of the biggest impacts, of course, of the pandemic is people moving all over the place. How does this impact businesses? What should nonprofits be thinking about in relation to remote employees?
Yeah, we're getting this question a lot. We have a lot of organizations. Obviously, COVID has changed the flexibility and the arrangements that employees have with their employers. So we're seeing people moving to a remote environment, whether that means they're working mostly from home, they're not going into the office on a day-to-day basis, they're moving out of state, whereas historically organizations have been operating in a way that employees have been local. They have not local employees outside of their counties, outside of their cities, outside of their states, sometimes even outside of their countries. I'll save that for a different topic. But But what we're seeing is as a result of that, and I'm sorry, I'm getting a note that my signal is weak, so hopefully everyone can hear me okay. But one of the biggest impacts that we're seeing of that, and one of the biggest questions that we have is how do we handle that from a payroll tax reporting area? There would be a requirement to adjust your income tax withholding if you do have an employee that moves out of state that has changing their residence. There are a couple things that you would need to consider in terms of compliance. First, you'd want to look to income tax withholding and potentially the need to obtain a state-required withholding certificate from the state of that employee. If you don't have a presence there already, that's something that you might need to do. So if you have an employee that's historically been in California and they want to go to Georgia, you've got to go to Georgia and see what their requirements are in terms of your employee being there. The registration with the Department of Revenue might be required as well. This can be a little bit challenging if you're doing your payroll in-house versus, outsourcing it to an ADP or similar type of payroll organization. But it's something that would have to be done and is different for every single state. The definition, the requirements are different for every single state. So other things that you might have to consider is unemployment insurance. So you might have to register with that state's unemployment department, or the state's employment department rather, to see if there's a requirement for withholding SUI and remitting for that state. Each state has generally a different test to see what those requirements would be, but you definitely look at the base of the operation, the place of direction and control for that individual and the residence of that employee. There are other types of business tax implications as well. Once you have an employee in a different state, it puts your organization as having nexus within that state. So there's a possibility for other types of taxes and implications. So maybe there's some unrelated business income that might be allocated if that's something that your organization has, sales and use tax, gross receipts tax, those all could be applicable for those states as well. Finally, other considerations outside of the tax world would be workers' comp insurance, potentially a requirement to register with a Secretary of State as a foreign organization doing operations in that state, and as a nonprofit, maybe Attorney General registration as a nonprofit operating or soliciting in that state, depending on what that employee is doing. So a lot of different considerations there. And that doesn't even go to the to the question of how do you handle internal policies, procedures, and reimbursements. So I'll talk a little bit about that, what an organization might need to do, because I see some comments online about how you are reimbursing travel expenses for travel for that employee. And I will say the one thing to note is that the IRS is just now providing updated guidance relating to internet activities. So the internet's been around for about 20 plus years, and we're just getting now updated items relating to like how to account for activities online. And so we don't have specific guidance regarding remote employee work arrangements yet. But what we have been doing is taking a look at the current guidance regarding travel, where an employee's tax home is, to help to talk to organizations about how they should update their policies and procedures. One of the first places to go is to go to your organization's accountable plan and take a look at what your current expense reimbursement policies are relating to travel. Something that's not usually reimbursable are commuting expenses. And I know that a lot of organizations have historically done the home office home calculation to figure out what a commuting expense would be. But when you have an employee that doesn't have an office anymore, maybe they've become a completely remote employee, even if they're within the same city as their business, or maybe they've moved out of state, what does commuting look like? So in the cases that you have an employee that still lives in the same physical space as an office, that employee's tax home isn't where they're living. Their commute is anywhere within the vicinity of their office. So if they live in the same city as that vicinity, anytime they travel into the office, generally that wouldn't be a reimbursable expense. That's still part of their commuting expense. There are different requirements when you have field employees that go to different locations. So there's a lot to take into account in those areas as well. But then another thing to look out for is when you have an employee that lives in a different state and they're required to come to their home base for meetings, is that a commuting expense as well? Generally, it's something that we don't have a ton of guidance on, but if it's outside of that organization's, that individual's tax home, then that may not be a commuting expense for them to fly to their office. So there's a lot that goes into that. And I know that we have some questions that have come in. Tracy, are there any follow-ups that you have? Because there is a lot that goes into all of this.
There certainly is, and there are so many questions on this topic. We can refer people to the IRS publications having to do with reimbursing employee expenses to get the definition of tax home and start putting together policies. So, I've been getting the question a lot of, gas prices have gotten so high, my employees want me to reimburse at a higher rate than the federal rate, which is kind of the same issue of my employees want me to reimburse for commuting. So is that okay? What are the ramifications of doing that type of outside of IRS guidance reimbursements?
Well, I haven't specifically dealt with that higher reimbursement rate, so I don't know if any of the other panelists have dug into that at all. But I've always considered that anything outside of what they've stated that the reimbursable rate would be a taxable benefit to that individual. So if you want to provide additional stipends, provide additional gas money, any type of amount that you give an employee that is outside of what's an excludable amount for taxable income in accordance with an accountable plan, that amount would generally be taxable to that employee. It's kind of a safe bet to just say it. If it's outside of what the exclusions are that we have, it's going to be taxable to that employee. The rate that we have that the IRS has calculated accounts for not just gas per mile, but it accounts for the costs of car maintenance and wear and tear to a car. So they do account for all of that when coming up with that reimbursable mileage. I guess there are ways that you could do a direct expense, a direct reimbursement or a direct deduction, but tracking that would be very difficult to have. If you fill up your tank of gas, how much of that was for business, how much of that was for personal. So, that reimbursement rate is designed as a way to keep things a little more simple for organizations that already have a lot to deal with in terms of compliance. Any other thoughts from the panel on that?
Yeah, please. Patty, Chi-Wen, anything?
No, yeah, I'm just going to say I agree with what Lauren said. I think it's going to be taxable income, unfortunately, unless it fits a fringe benefit or some sort of allowed deduction and stays in the business area.
That's a safe bet. The publications that we have the publications that we have do have some really good guidance on determination of tax home. How do you determine where that employee's tax home is? You take a look at, where they're performing the most of their duties. Do they have are they duplicating living expenses in terms of their home and where their business requires to be when they're away from home? Is it their historic place of lodging where their family is? There's a lot of different determinations to walk through if where that employee's tax home is, where they reside, and how those two are connected. So I would really encourage digging into that guidance. I would say it's clear as mud, but it can help to make sure that your accountable plan is updated for how you're reimbursing your employees as well, because everything points back to your accountable plan.
And in our resources that we have, materials that you can download from this presentation, Lauren provided a great table on walking through some issues to be thinking about when you have a remote employee, and columns for states, if I remember correctly, just to document the inquiries you've gone through and who you might have in different states.
Yeah, and I'm seeing there's a lot of different questions about how do you handle employees when you buy them business assets for their home and when they depart. All of that should be connected in your accountable plan, as well as your fixed asset policy, how to handle and manage assets that are maintained by employees, to see if there's a benefit for that in those certain cases. I haven't seen too many of the fixed asset policies addressing this yet, but I think it's something that's going to be becoming more and more prevalent in terms of that. I also see, is there any high quality online resources for local labor laws that compiles everything? I don't know of a spot for that yet. I don't know if anyone else has seen that, but again, it's like anytime you get a state and local tax issue like UBI or property taxes, every state is different. Every state has a different requirement. If you have employees that are working partially in their home state and then they come to another state like California, there could be a possibility that you have to withhold taxes for both of those states, and they might have to file multiple state returns. So every state has its own rule on that.
Well, I think based on all the questions we have coming in, we probably need to do a whole webcast on this topic.
Absolutely. We'll get working on that right after.
I know, not at all surprising. So we're not going to get into professional employee organizations or those types of planning strategies on this session because we do have other topics to cover. But we'll go ahead and go to our second most popular topic here. We're going to combine the Green Book and the ACE update. Patty, if you want to chat about what you've seen in the Green Book that affects our nonprofits.
Yeah, very good. So the Green Book, that was published in March of 22, and it's proposals for the administration to think about revenue proposals, what we should be doing. And there were actually two provisions in there that affect nonprofit organizations. The first one, and that one kind of parallels with what I'm going to be talking about with the ACE Act. But on the Green Book, they focused on private foundations making qualifying distributions to donor-advised funds. So a private foundation is required to pay out approximately 5% of its non-exempt use property. So that's typically your investments in cash. So 5% of that needs to go out for charitable purposes every year. And some private foundations have used the vehicle of moving money over to a sponsoring organization like a community foundation or Fidelity and put it in a donor-advised fund. So a donor-advised fund, they've given up the asset. It's owned now by the sponsoring organization, but they maintain advisory privileges, and they can dictate when it's paid out. A lot of times it may depend on your agreement with a sponsoring organization, what their rules are and what you've signed up for. But in general, you're allowed to advise where money goes and the timing of where money goes. So under the provision, they're saying, okay, private foundation, you can treat this towards your 5% payout requirement as long as the donor-advised fund pays the money out within the following year. So they give it another year to get paid out by the fund into the public, into different charities, wherever it's going. They're following the rules which are already established for a private foundation if it gives money to a related organization or another private foundation, because they want the money going out into the public. They just don't want it transferred organization to organization. So that actually is one of the restrictions they had. What's notable, and this will make more sense when we talk about the ACE Act, but they have not addressed the restrictions to community foundations or the sponsoring organizations holding the donor-advised funds. So if we move to that one, the ACE Act, this one was actually, the Senate introduced this first in June of 21, then the House introduced an identical bill of February 22. On the private foundation side, they had the same requirements saying, okay, you guys cannot have a qualifying distribution unless the donor-advised fund pays it out in the same year. So that a little bit more restrictive. The other big problem in the ACE Act was that it's effective for year 22. So we're thinking, oh, what if I'm a private foundation? I don't know if this is going to be passed or the Green Book version is going to be passed. I'm making distributions to donor-advised funds right now. They need to be very cautious and have a plan. How am I going to get this money out if the trigger's pulled and I need to spend all this by the end of 22? So other people in this industry are thinking they'll probably not make it that restrictive. They may push it to 2023 if it's enacted in 22, but we don't know where that will go. So there was a lot of the whole proposal on the ACE Act, a lot of it was years of work done by part of this group, the Initiative to Accelerate Giving. And that was funded by John Arnold and supported by academics such as Ray Madoff and others. And what they're looking at is, okay, if you move money to a donor advised fund, it can sit there. They don't have the private foundation rules where you have to do a 5% payout. It can just sit there. And how is that going to charity? Now, the donor gets a deduction immediately for funding it over to the sponsoring organization, but it hasn't moved. It hasn't gone to charitable purposes yet. So they're very concerned about that. So what they created in this, they have a 15-year donor advised fund, which is a qualified donor advised fund, or a 50-year. So what they're saying is that what they people that are supporting this would be that, yes, you can put money into a donor advised fund, but it has to be all of it distributed within 15 years. And then also there are other restrictions where non-public assets, so maybe a closely held business, you don't get the tax deduction until that's sold by the sponsoring organizations. Publicly traded stock they're not worried about, or cash, but they were putting another level, like when the donor actually gets the deduction. For a 50-year DAF, on that one, you don't get a deduction for non-cash donations unless the sponsoring organization sells it and distributes it. So more of a harsher rule. Now, community foundations, they were hit a little harder on this. So the general rules are for your Fidelities, your Schwabs, that are big institutions holding donor advised funds. Your community foundation in your local area, they have a further requirement where the DAF has a 5% payout requirement, or its value in the aggregate of all the DAFs they hold by the sponsoring organization hits $1 million. Then you don't have to do that. But the community foundations have been very vocal on this. They, it could be a nightmare for them tracking this. How do we even figure out what their minimum payout is? Is it what the fund holds? What if they're part of a pooled fund? I mean, it can be a pretty hard calculation. And the other big one is, this is huge for recipients from DAFs. If you're a charity and you get DAF money coming to you, right now the rule is it came from the sponsoring organization. That's typically a publicly traded, it's a public charity, and it's considered usually good money. It helps your public support testing. It doesn't hurt you. But here they would look to who created the DAF. That's who the donation is from. So you could, some charities may be at risk for meeting the public support testing if they're heavily funded from donor advised funds, which are coming from a specific creator of the donor advised fund. So that's going to be a lot of tracking. The effective dates for these would be after date of enactment. So again, you could look at it, well, we don't know if this is going to pass for the community sponsoring organizations. It wasn't in the Green Book, but private foundations are hit on both sides. So chances are we could be seeing changes for the private foundation group. On the private foundation group under ACE, they also wanted to not allow administrative expenses that are going to disqualified persons. That wouldn't count as part of your payout requirement. And the other thing is they would waive, this is a good thing. So right now a private foundation pays 1.39% on their net investment income. So they said, okay, well, if you pay out instead of 5%, if you pay out 7%, we'll waive that tax. You don't have to pay it. Or you're set up as a limited duration private foundation, meaning you sunset after 25 years. You don't have to do it. So, and then this is as long as the private foundation isn't distributing to other private foundations unless they're also have a duration of 25 years. So it's interesting. The whole goal of this is try to move the money out into the general public for charitable purposes, is what they're trying to do. So it'll be interesting. Does anybody on the panel have any predictions or comments you might want to add?
I'd love to see some movement on this. I mean, there's a whole lot of change in here, but really what I've been seeing, and anyone else can comment with, when we see legislation like this that has several different provisions in it, often the legislation doesn't get through as proposed, but we see bits and pieces picked up in other legislation, like a transportation bill or a military funding bill, where they need a revenue raiser. So I don't know about you guys, but I've seen that happen before, where we could see this pop up in some other kind of legislation if the ACE Act doesn't move forward.
Yeah, I agree. They're very good at that because everything's already tied down by attorneys. They have it all written. Just slip it in. Like with the pension protection.
There seems to be bipartisan support. So it seems like something that, one rare thing that people can agree with from the congressional perspective. I think in the charitable world, there's a variety of opinions on this.
Yeah, and I was just going to add, it just adds a hardship to the community foundations. They have a lot more tracking and a lot more work. So I know they're lobbying this pretty hard.
I've been seeing in the chat lots of questions about the polls. The purpose of this presentation is not to give you a bunch of slides. We're just going to be talking through things. So that's why you're seeing the spring not-for-profit tax update up. And we'll move to the next poll because we do have another set of questions that or topics that we would like to propose to keep things moving and give you CPE credit. So hopefully you've all got the slide screen up now and you can see the 4 options of cryptocurrency, virtual fundraising, dealing with the IRS, or unrelated business income tax siloing and Form 990T issues. We'll throw 990 issues in there too, because we didn't have that as a separate question. So I'm seeing some people are starting to answer it. Good. While we're waiting for that poll to close, there was a question on what's the difference between donor-advised funds and restricted funds. Donor-advised funds is a very specific term that has to do with giving money to a sponsoring organization, like a community foundation, where the donor's retaining advisory rights, and the sponsoring organization is supposed to listen to those advisory rights, and it goes to more than one organization. So if I set up a donor-advised fund with the University of Idaho, and it only benefits the University of Idaho, that's not a donor-advised fund. That might be a restricted fund, though. But if I give it to the U of I and say, you have to then direct the money as I want it, like to different humane societies and such, then that could be a donor-advised fund. Hey, we've got good participation on the poll here. We got 414 out of 457, so we'll give people just another minute. Want to make sure that you're participating and getting credit. All right. Closing the poll. Unrelated business income tax siloing and 990T issues is the top topic. So, Lauren, what do you have to say on siloing?
That's me. I have been responding so much to all the questions in the Q&A about the remote employee item. So I'm not quite prepared for it to be me at this point. But no, where we stand on the no, I'm good. I can talk about siloing in my sleep. It's completely fine. So where we stand on siloing is that at the end of 2020, we got our final regulations regarding separate trader businesses. And these final regulations actually provided a good bit of relief for nonprofits in that it went to nonprofit organizations using a 2-digit NAICS code as opposed to the 6-digit NAICS code for their siloing. And so that really limits the silos that nonprofits have to deal with to essentially a little over 20 NAICS code silos. I think if I'm calculating them correctly, it's a little bit over 20. Still pretty complicated. A lot of the NAICS codes don't really fit into what our organizations are doing in terms of operations, but it's better than having to separate out by every 6-digit NAICS code. So when you're determining your silos, first you're going to look at your unrelated business activities and figure out what that activity is based on a 6-digit silo, and then group them together based on the first 2 digits. So reporting is much easier in terms of your unrelated business activities. But where we're seeing most of the complexities in the area of siloing come from is something outside of those NAICS codes, which is the aggregation rules for investment silos and how to handle those, especially when it comes to alternative investments. So just a quick little refresher on this. UBI and silos can be aggregated when you have alternative investments, partnerships, S-corps, or debt-financed income. UBIs from certain types of investments can be aggregated into something called essentially the QPI silo, or I guess the investment silo, which includes your QPIs. When we look at what is a qualifying partnership interest, this applies both to partnership and S corporation interests. You look essentially to a couple different tests. The first test, which applies to a vast majority of the publicly traded partnerships and other types of investments that we see in organizations, is the de minimis test. So if you have less than 2% of the profit interest or capital interests, you're not a general partner in a partnership, that can get lumped into this investment silo. If you have more than 2%, and you're still not a general partner, the next thing you would look at is your participation. Do you have no more than 20% the capital interest, and are you not significantly participating in that partnership, which means that essentially if you're not significantly participating, you don't really have influence and the ability to significantly participate in the operations or appoint or remove officers or employees or have overlap in that kind of controlling element. So in those two tests, if you meet those two tests, then you can lump all your interests as kind of in that investment silo. If you have more than that, or you're controlling or a general partner, you have to look through those partnership activities and look into those sub-investments, the sub-partnerships, the lower tier partnerships, to see if they meet the de minimis or participation tests for themselves. And if not, you have to take the information and try to lump that information into the NAICS codes that we have, which can get really complicated because a lot of times the K-1s that organizations are receiving don't have a lot of this information. So really, our biggest tip, and one of the things that we've been working on, is connecting with the partnerships and the advisors, the CPAs, the tax firms that are preparing those partnership returns, and letting them know the information that we need. So for example, in order to determine the percentage of ownership, we need the actual beginning of the year and the end of the year ownership percentages and capital percentages, income and loss percentages as well. We can't just have various. We need to know a beginning and end of the year are, so that we can average them out to see where we fall from that 2% to 20% or above. So oftentimes we'll have to push that back to get that, because it's not enough that we don't have that. If it says various, we can't just throw up our hands and say, well, it can't be much. We also have to ask about the sub-partnerships and those ownership percentages, as well as, if we don't have that, if there are activities that we have to look to, we have to get those NAICS codes so that we can, gather that. So it's a lot more work that's gone into alternative investments, as if they weren't a lot of work to begin with. But, the big lesson here is check your K-1s, make sure that you have the proper information that your advisors need or your team needs to assess. Keep your tracking sheet. Having a good K-1 tracking sheet is everything. A lot of times, when we've gone through examinations of alternative investments, the IRS just asks to see the tracking sheet. They're not necessarily auditing every single number on it, but keep those tracking sheets available, and keep them available as long as you have NOLs. So one of the other complexities of kind of the UBI siloing and where we're at there is net operating losses. Essentially, we're dealing with three different kind of buckets of pre-Tax Cuts and Job Act NOLs, CARES Act NOLs, which has slightly different characteristics. A lot of these NOLs, and in order to use an NOL, you need to have that source information for when that NOL was generated. So maintaining your information about the creation of those NOLs, that's the organization's responsibility. So getting that information, maintaining it. We know organizations jump to different firms every couple of years sometimes, and you want that if you're going to use that NOL, because it could be denied if you don't have that information going on into the future. I'll pause there and see if that's where we're at with siloing right now. Does anyone else have any thoughts on tips or tidbits on siloing?
Well, the IRS has reserved regulations relating to expenses. So sometime we're going to get regulations on how we're supposed to allocate expenses. They've been promising that for years. I know on the TRP that Chi-Wen and I sit on, we've given the IRS suggestions on examples on how to split expenses. They still keep pushing it off. So for now, any reasonable method of allocation is still what we go by. And more guidance is coming on NOL usage, which has been horribly complicated over the last couple of years with siloing and carrybacks and carry forwards. So another topic that we should probably have an entire session on, I know that I've taught it, several of us have taught it at different conferences. So if you'd like to have a whole 60-minute session on unrelated business income, expense allocations, NOLs, what is UBI, please let us know in the chat. We're looking at our next topics that we're going to be presenting. We do have a fall update, but we could squeeze in an unrelated business topic if there's enough interest from this group. So please let us know. Chi-Wen, do you want to talk for a few bit? Oh, yeah, go ahead, Lauren.
I was just going to say really quick, the 990T is continuing to evolve as well. I know we said 990T issues. So 2020 looks different than it did in 2019. We now have a kind of compiling page 1 of the 990T itself. That's where all information from all the Schedule A's, which are for each silo, are aggregated into one. And 2021, we had an additional update to the 990T where they now have NOL tracking information for each silo, as well as pre-Tax Cuts and Job Act NOLs on it. So, that we're seeing the form evolve, thankfully, as the guidance evolves. So at least it's a little bit cleaner in terms of the prep.
Hopefully it'll stop moving now that we've got a few years of siloing under our belt. It seems to be getting there anyway. Chi-Wen, do you want to talk a little bit about virtual fundraising, what we've been seeing, guidance that's come out?
Yeah, sure. But one comment on the siloing rules. I know there was welcome relief with the participation test where you don't have to look at the interest of disqualified persons. Organizations don't have to ask their board members and directors and seeing if they also invest in the same investments as the organization and aggregating those interests. So that was welcome relief there. So recently, the IRS issued some guidance on crowdfunding and how that impacts nonprofits. So there was new guidance that was issued in March of 2022 that clarified the criteria for filing a Form 1099-K to report payment card and third-party network transactions and how this applies to crowdfunding websites. Prior to 2022, the 1099-K was required for gross payments that were over $20,000, resulting from more than 200 transactions or donations during the year. Now, the American Rescue Plan Act has changed this criteria. So now starting in 2022, the 1099-K is required when you have payments that exceed $600, regardless of the number of transactions or donations, and the contributor received goods or services for their contributions. So this new guidance really clarifies that when a contributor makes a payment without receiving any type of anything in return, no goods or services, and it's made as a result of the contributor's detached and disinterested generosity, that payment would be considered a gift, and it's excludable from gross income for that recipient. So it's not reported on the 1099-K. So for nonprofits that generally engage in a donation-based crowdfunding where contributors are not receiving these goods or services in return for their gift, then that payment is not reported on the 1099-K. So really this 1099-K form is applicable for reward-based crowdfunding. So think of Kickstarter, where contributors receive a reward in return for funding a project, then that is actually taxable and reported on the 1099-K. There's a handout. There's actually a link in the IRS guidance later in our slides if you want to read that in whole. Also, I want to just add that last October, Governor Newsom also signed into law AB 488 for California that allows the Attorney General to start regulating what's called a charitable fundraising platform, and these platform charities that operate in California starting in January 1st of 2023. So this AB 48 is really meant to protect charitable donations that are made through these online platforms like crowdfunding websites to ensure that their donors are well informed of where their contributions are going, they're protected from fraud, and that the charities are properly receiving these donations. So there's two definitions that were added. The first is this charitable charitable fundraising platform. And what that really encompasses are these, crowdfunding websites like GoFundMe, online companies that solicit donations for charities and engage in solicitation, like Amazon. If you buy something on Amazon, about a small percentage of that purchase goes to Amazon Smile, which is the charitable arm for Amazon. And also Facebook, they do allow charities to create websites where you can fundraise through Facebook. So now that is all regulated under the California Attorney General. And then there's a second definition, this platform charity, that helps these charitable online platforms fundraise. So if the donation is not going to a recipient charity, the intended ultimate beneficiary of that grant, there is a intermediate nonprofit that helps facilitate that donation. They are also that are now purview under the California Attorney General. So these rules, there's additional rules that require registration and reporting to the Attorney General. There has to be an agreement in place to secure written consent from the charities before using their name for online solicitations. The donations have to be held in a separate bank account and distributed promptly after it's donated. There has to be a detailed accounting of all the fees that are collected from these donations. The platform charities, as well as the charitable platforms, have to verify that the charities that they're fundraising for are in good standing with the Attorney General. And lastly, they have to require to report conspicuous disclosures to the donors so they know exactly who the recipient charity is that are receiving the funding. So California Attorney General has really been the trailblazer for issuing these new regulations on the crowdfunding activity. And I think other states will also follow in their footsteps. And so you might see some rules that are coming out from other regulators.
So for years, we've been talking to clients about the Charleston principles and at what point you're tripping required registration in different states for fundraising. So it sounds like this could be kind of the next evolution potentially of the Charleston principles on states requiring us to register. Is that what I'm hearing?
Yep. Absolutely. Yeah, and I think also, too, a lot of these rules, the framework for AB 488 came from the PayPal settlement fund as well. So then that's something, in the interest of time, I'm not going to go into, but I would say definitely Google that because there's a lot of rules that came from the settlement fund that are applicable in this framework.
All right, very good. Well, we've got about 12 minutes left. We'll go to our next poll. Make sure that we get our CPE credit in. I'm not seeing the actual question showing up on here, but the question is, have you had interactions with the IRS in the last year? We've been seeing all sorts of, hit F5.
Oh no, we lost Tracy. Oh, there she is.
I'm back. I got the message to hit F5, so I wasn't sure if it was to me and you guys couldn't hear me, but hopefully, thumbs up. Can you hear me all right?
You sound great.
All right, fantastic. So the poll, there it is. Have you received notices or had interactions with the IRS during the pandemic? We have 367 people submitted. So while I was having technical problems, apparently y'all were seeing it just fine. So I know we didn't talk a whole lot about the IRS today. It was one of our topics, but there's so many good topics to talk about. It's for most of us, it's been a very painful process with very long hold times. If you can even get through the due to high call volume, please call back another time, regardless of what day or when you call. Hopefully not too many people on this call have had to go through that painful process. I still have results coming in, so we'll give people just another minute so you can vote and get your credit for CPE. So the results is no, thankfully, wonderful, with 52.4% of people reporting that they haven't had to deal with it. Unfortunately, the next highest was yes, and it was a painful process, and that has been what we've seen, and really not a whole lot of relief in sight, unfortunately. So we'll go on to our final polling question, and then we'll have Patty talk for a couple minutes about employee retention tax credit, and then we'll have a few minutes left for questions. Our panelists can kind of do potpourri, either follow up on questions that were asked or other topics that have come up in the chat. So if your organization claimed an employee retention tax credit, which of the following is the case? So poll is open. We did not claim an employee retention tax credit that was available from March of 2020 through September of 21. We claim credits on payroll reports only, so taking it as a credit against your payroll tax due on your Form 941 quarterlies. We claimed a refundable credit and have not received the refund. This, unfortunately, is not an unusual response to our polling question, as we've been seeing. And we claimed a refundable credit and have received the refund. We hope many people are answering that you not only took advantage of the credit, but have gotten your money, or not applicable. I generally need to have that as an option because some of you may not be filing returns. So results are coming in a little bit slower on here. Patty, do you want to give us just kind of a high level, what are we hearing about employee retention tax credits? What should people be looking for to see if they're eligible?
Yeah, sure. So the employee retention tax credit is actually really, really nice. You get it by filing an amended 941 right now because it stopped effective September 30, 21. So you would get it by amending your payroll tax reports. Generally, those need to be filed within 3 years from the date of filing or 2 years payment of the tax. So 2020 filings are starting to, if you're doing it based on tax, you better file quickly if you can catch it. 2021, it's still open to file for that. The rules changed quite a bit in 2020 when it started. You would look to have we been affected by closures because of government orders, partial, full closure. We can't do anything. We can't do our mission. We're not allowed to. We're shut down. Or you look at a 50% reduction in gross receipts. That was a pretty high bar. The comparative quarters would be 2019. So calendar quarters of 20 to 2019. The credit was allowed if you let people keep working if there were fewer than 100. If you were over 100, they couldn't work and they were still receiving wages. And it was a 50% credit up to $10,000. So you were able to get for the year $5,000 per employee. 2021 came along and they really made a nice change. They changed the limit of full-time employee equivalents. Instead of 100, if you were under 500, your people could still be working. Similar rules, there was a shutdown order, or you have a decline in gross receipts, which now is a 20% measurement from 2021 to 2019. The credit also went up. It was 70%, and it was based on $10,000 per quarter. So you could have a maximum per employee credit of $21,000. Things to watch out for in this is you can't double dip. If you had PPP funding, you look at what wages were claimed there for the PP loan forgiveness. Do I have any left to try to get the employee retention tax credit? And you also look at health insurance that was paid. So those are the two expenditures for this. The other thing is maybe you have other government funding coming in that's supporting a program and it's paying for wages. Here again, you have to, as a nonprofit, you have to say, all right, the government's paid for this, I can't double dip. So you really need to be able to put into buckets where all the payroll was paid and if there's any credit available for you. The IRS is super slow on processing this, as Tracy claimed. Many businesses and nonprofits haven't seen a refund. They may, I've heard it over a year for them to process. You just don't know. It can take forever. And now the IRS is starting to send out what we call information document requests. That's if you're under examination. I think Lauren's seen one of these. I haven't seen any yet. But they want to know, what are the work papers that you used to prepare the 941X? How did you document you're an eligible employer? Is there a reduction in gross receipts? What government, if not, if you used government orders, Was there more than a nominal amount of interruption, which is usually 10%? Like what are you using to qualify? They want to see all of that, government orders or your gross receipts calculation. How did you calculate the average number of your full-time equivalent employees? That they're looking back to 2019 as a measurement. What employees qualified for wages? How did you allocate your health insurance? How did you determine if you're part of a group where you have to aggregate your gross receipts or your employees to make sure you're under that 100 threshold or 500 threshold, depending upon the year. And if you got PPP funding, how did you figure that out, that you weren't double dipping? So they still have to process a whole bunch of these, but they're already active in sending out information to people that have claimed the credit. Anybody else?
It's been a very lucrative credit for some of our clients if you can document either the reduction in gross receipts or the shutdown of a more than nominal portion of your business. So we have a lot of experience helping identify if an organization is eligible and helping do the calculations, but certainly worth taking a look at. And you do have 3 years to file those amended payroll tax reports. So don't lose out on the opportunity. We have quite a few people who did not claim the employee retention tax credit. So you want to make sure that you've looked at if you can take advantage of that credit or not. Let's see. So where do we want to go from here, panelists? We've got 5 minutes remaining. Did someone have a question that they wanted to answer that was in the chat or another topic we didn't get to for just a couple minutes?
I wouldn't mind just pointing one thing out on cryptocurrency that I had more to talk about. But what I wanted to point out, if you do receive cryptocurrency and the value's over 5,000, as a charity, you need to sign off on Form 8283. That's where the donor really needs that for their tax return. But it's where all you're doing is saying, we received this property and the date we received it. For cryptocurrency, that's what you would be explaining, but you need to keep a copy, because if you sell it within 3 years, you're required to file the Form 8282. And that's where you show the IRS who was the original donor. It's all your information is going to be on the 8283 you signed off, and then list them, the date you received it, the date the donor received it, did you sell all of it or part of it, and what did you receive? So a lot of organizations don't realize that falls under this virtual currency requirements. So just be aware of that.
I also wanted to add in, make sure to check your in-kind contribution policy to make sure that digital currency NFTs are addressed there as well. There's a lot of different options for receiving them. You can receive them directly, get your own crypto wallet. That takes some time to set up. There's also other companies that'll kind of wash it for you, so you'll pay a fee similar to what we see in like the in other areas, like the car donation area, where they take the funds, they take the crypto in, they sell it immediately. And if they're a nonprofit, they might be doing these filings for you. So you might not have to go through the trouble of getting that 8283 and then filing the 8282, because this organization will do it for you for a fee. So we just would encourage to check those policies, make sure you have, are you limiting what assets you're taking? Bitcoin is a good one, takes up 50% of the crypto market, but there's a lot of other ones that are much less dominant that people might be trying to contribute in, as well as NFTs, which are their own kind of deal. So definitely that's something that we would encourage in that area.
Yeah, and also I was going to add that a lot of younger donors want to give cryptocurrency. I mean, that's attractive to them. It is worldwide, it's over 3 trillion in virtual currency. It's huge. That's not all in the US, but even if you let your donors know we are accepting this now, you might attract a new donor base and get the young ones in.
And we highly encourage you to be thinking about this in June, not on December 28th, when you get that last minute request from a donor. You don't have a wallet, you don't have a third party set up, but you don't want to upset the donor. So please consider that early and often. So with that, we have about 1 minute left. So Danielle, I think you had some closing remarks you needed to make.
Yes, thank you, Tracy, and to our panel for a great discussion today. There's a few slides that you'll see here with resources for you to look through. I also want to thank the audience for being engaged and submitting your questions to help guide today's conversation. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. Also, feel free to reach out to our presenters if you have additional questions. If you met all CPE requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download. A copy will be emailed to you within 3 weeks should you have any difficulty downloading it now. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in your console. And finally, here's a link to an online survey for today's presentation. Thank you for joining our webcast. We hope you'll join us again next time.